The first question I've got is one that we're being asked all the time, and that is, are we at the end of the 30-year rally in bonds?
Well, if you base it on the fact that the Fed is going to tighten interest rates, I think the expectation, at least my expectation, is the rally in bonds should cease for a while as the Fed begins to tighten interest rates, and therefore bond yields should begin to gradually move higher. What we are expecting is the Federal Reserve to begin tightening rates, bringing rates higher, but at a gradual pace, because the US economy is expanding at a moderate pace, and though the labor market is going to tighten, we're not seeing inflation. So the Fed can continue to be patient, but begin to raise rates in a very gradual fashion.
So where does that leave us for people who want to invest in Asian bonds?
Right. Now, for bonds generally, in a scenario where to some extent higher interest rates from the Federal Reserve is expected, but also that this rate of tightening is going to be gradual, bonds generally should keep its yields quite well. Now, for Asian bonds, whereby you possibly will get 4% yield, and that's not difficult to get, either from an Asia local bond or a Asia US dollar bond. Given that kind of attractive yields, this yield levels should be able to buffer any moderate losses that could come as a result of Fed tightening interest rates.
Now, of course, that's only half the equation with Asian local bonds, because, of course, a lot of our clients will be saying, well, if we're going to buy Asian local bonds, even for the yield, what kind of currency risk are we going to be taking on?
Well, certainly there is local Asian currency risk. That is something which investors has to be aware of. Now, the strength of the Asia local bond is, firstly, is diversified across 10 Asian currencies. Secondly is the fact that if you compare to a few years ago against the major currencies, Asian currencies has actually fallen to fairly attractive levels. Now, what then is the possible prospect is that we begin to re-strengthen, that these currencies may go back into a strengthening trend, because what we are seeing are longer-term positives. Longer-term positives from China, whereby President Xi is going through a lot of reforms and economic restructurings. Prospects of President Jokowi in Indonesia improving the economy through infrastructure spending, and also a lot of reform measures taken by Prime Minister Modi in India, another large economy, which should provide for stronger growth in India, which we are already seeing.
Last year we saw a move from developed market bonds into Asian bonds because of the negative yields and the big interest rate yield differential. Are we likely to see a continuation of that movement this year?
Now, the negative yields, even if it persists at these levels, would make Asia quite a natural choice for new monies or divestment of monies from either Europe or from Japan. It is my personal view that in both these countries, Japan as well as in the Eurozone, that these negative yields will be quite persistent, because the inflation rates generally are quite depressed. And there is a lot of economic slack in these regions and their economies, and therefore having to get inflation back up means that negative yields and easy monetary policy in Europe, in the Eurozone as well as in Japan, should persist. And we could possibly even see interest rates not remaining negative and not being brought up, maybe even up to 2020. So
the bottom picture seems to be that despite all of these global winds that are circulating, the outlook for Asian bonds, both local and US dollar, is actually pretty good for 2017.
It is positive. It's positive from a attractive yield to maturity. It's positive from the point of view that global yields, although they may rise with Fed tightening, would only rise gradually. It's positive from the long-term fundamental improvements that we can see out of Asia, in India, in China, as well as in Indonesia especially.